Hi there. My name is Sandra and I'm the principal broker at the Mortgage Center in Guelph. I just wanted to give you another update on what's happening with mortgage rates and the real estate market for the spring of 2022. And this is some really great insider information and just an analysis to let you know that we are taking care of things when you call us. So the Federal Reserve in the US has signaled and is now raising interest rates. And they are thinking that rates are going to increase somewhere between, they're going to make 5 to 6 rate increases in the next year to year and a half. And that actually now gives the Bank of Canada the green light to continue to raise rates. So when the Bank of Canada changes their interest rate or increases or lowers their overnight lending rate, that in fact will impact your variable rate mortgages. And no surprise, we've been talking about this for at least 6 months. And the bank now, before the pandemic, the mortgage prime rates were close to 4%. Right now, they're at 2.7%, and most people are getting prime minus 1%. So, we are going to where rates should be historically. So what does that mean? Do I pick a fixed rate mortgage or do I stay with my variable rate mortgage? So I think you've heard this from me before. If you can't sleep at night, lock in your fixed rate mortgage, but you will be locking in close to 4%. And most of our clients have a variable rate mortgage of prime minus a certain percentage. Okay. And so I would say if you have a variable rate mortgage, now is the opportunity to make extra payments on your mortgage and prepay it. Most mortgages have that option to prepay each payment. That's actually how I make my mortgage payments. I'm generally not a great saver, but I know if I'm forced to make those payments, I will make them. Okay, so I've set my prepayment on my mortgage as high as possible just to pay down on the principal. So we talked a little bit about variable rate mortgages, what's happening with fixed rate mortgages. And you may have been surprised to hear me say that you'll be locking in on a 5-year fixed rate close to 4%. Well, fixed rate mortgages, as you know, and we have talked about this, are measured off the bond market, the 5-year bond. And new inflation numbers are coming out and inflation continues to be persistent. Now, the Bank of Canada says that it might be short-lived until some of these supply chain issues have been resolved. I did read an interesting article recently at CBC Canada, and they said, wages are also increasing. So when inflation is going up, there's a relationship between inflation and the bond yields. And what happens is the yields go up. So when the 5-year bond yield goes up, so do fixed rate mortgages. So we're just seeing a general trend. Rates are on the rise. Don't panic. You're okay. If you really feel like you're in a pinch and you've got all this credit card and line of credit debt that you're having a hard time paying, because those changes in interest rates are now going to be impacting your overall monthly carrying costs, please call us and we can help you consolidate that into your mortgage. So how is this going to affect real estate? I think that's the next question. So rates are inversely proportional to housing prices. So, and that makes sense. When rates go up, mortgage payments generally go up. And then that tends to cool the real estate market. Is that going to happen this time around? Not likely, because what we're starting to see is that more often than not, people have a lot of equity if they're buying and selling, right? So they're buying high, but they're also selling high. And that impacts their down payment and their monthly carrying costs on that mortgage. I'm also seeing many first-time home buyers get unusually high down payment gifts because their parents are saying, I want to help my children get into the housing market. I have made some really great gains in real estate, so I'm going to gift my children a down payment so they can get into the housing market. So we're not expecting housing values to decrease, and that's true what economists are saying. because there's also a ton of demand. I also did want to change gears a little bit and talk to you a little bit about a product highlight. For those of you who are self-employed, who have excellent credit, and are showing at least taxable income of $25,000 a year, we have been doing quite a few Manulife One products. So if you have good credit history and if you've been self-employed for at least 2 years, give us a call, or you can click the link below and schedule an appointment. I can walk you through the Manulife One product. It is a very unique financial planning instrument that allows you to access the equity in your home. So that's it for me. Thanks so much for allowing us to help you. And if we haven't, we would love to. Okay, have a great day.